So many of us, myself included, spend the majority of our lives focused on money. Earning it, spending it, saving it, investing it, winning it, and yes, of course, losing it. Money has become ubiquitous. It affects almost every aspect of our lives. Yet it's amazing how little people actually know about it. I mean, really know about it. Not just that it pays for things, but how it works, why it was created, who creates it, how it's created, what it actually does. These are things we should all know, but in reality, this is just not the case. The truth is, most people just don't have a clue as to what money really is and how it works. So in this video, we're going to go over some basic universal knowledge everyone should have about money. This is Martini. The Merriam-Webster Dictionary defines money as something generally accepted as a medium of exchange, a measure of value, or a means of payment, such as A. Officially coined or stamped metal currency, B. Money of account, and C. Paper money. Now, while this definition may explain what money is in the literal sense, it doesn't quite explain its true scope. To do that, let's first take a quick look at why it was created. A long time ago, before money, people exchanged goods and services through the barter system. Bartering occurs when two or more parties trade a good or service for another good or service. For example, a farmer might trade vegetables for tools with a blacksmith. The problem with bartering was that it made consistent assessment of value very difficult. In the previous example, the blacksmith might value the farmer's vegetables differently from trade to trade, depending on the blacksmith's perceived need of those vegetables at the time of the transaction, and vice versa. Another problem with bartering was the availability and lifespan of goods and services being traded. Using the farmer-blacksmith trade again as an example, the farmer was at a trading disadvantage when compared to the blacksmith, because the farmer could only trade during the time period after a harvest, and only for that time period when the goods were still edible. The blacksmith, however, could trade all year round, since tools are non-perishable and can be stored. Money was created to solve this problem. It eventually replaced bartering due to its use as a more independent, consistent, and universally accepted medium of exchange and measure of value. Nowadays, money is created by central banks who, along with the private commercial member banks, make up the central banking system. Central banks are politically independent financial institutions that are given control over the production and distribution of money and credit for a nation or group of nations. They're generally responsible for the formulation of monetary policy and the regulation of member banks. Central banks control and manipulate the money supply by buying and selling government bonds and setting the interest rate on loans and bonds. They also regulate member banks by setting capital requirements and reserve requirements, and can issue loans to member banks and even the government itself if the need arises, like in an economic crisis. Now, while central banks have a monopoly over the creation of physical money, banknotes and cash, the actual majority of money is created through the issuance of debt by member banks through a process called fractional reserve banking and the money multiplier effect. In fractional reserve banking, banks are generally permitted to lend out up to 90% of the funds they have stored on deposit, since financial institutions are only required to hold a fraction of client deposits in reserve. The funds from these loans, which are recorded and distributed as entries on a ledger, can then be deposited in another financial institution, who can do the same, and so on and so on. This repetitive process is known as the money multiplier effect. For context, a $500 million deposit can produce $5 billion in loans. Historically, central banks such as the U.S. Federal Reserve set the reserve requirement on transaction deposits to be about 10%. However, during the recent pandemic, the Fed reduced this requirement to 0 to stimulate economic growth. This requirement, or lack thereof, remains in force at the time of recording this video, and essentially means that banks can now issue loans without any reserves. Wait, what? How is that possible? How can banks operate with no reserves? Isn't this what banks are supposed to do? Store your money? Well, this may seem crazy at first, until you remember that central banks can print money at will. If a bank runs out of money, the central bank can literally step in and print money to bail them out. Sound familiar? Well, hold on. If central banks can print money at will, why can't they just print as much money as needed? Wouldn't this solve the problem? No. The issue is value. Money, like any other instrument of value, follows the laws of supply and demand. The greater the demand, the less supply, the harder it is to acquire, the greater the value. And conversely, the lesser the demand, the greater the supply, the easier it is to acquire, the less the value. In a nutshell, the more money in circulation, the less it's worth. This phenomenon is particularly evident in inflation. Inflation is the rise in prices, which can be translated as the decline of purchasing power over time. Inflation is caused by the increase in the money supply and usually occurs in 3 ways. 1. The increase in the supply of money and credit stimulates the overall demand for goods and services to increase more rapidly than the economy's production capacity, and this increased demand leads to price rises. 2. The increase in the supply of money and credit causes an increase in production costs, which is in turn then passed on to consumers as higher prices. 3. When prices rise, wages rise too, in order to keep up with and maintain living costs. Inflation has a direct impact on all of our daily lives and is one of the most important factors affecting our economy and society as a whole. So what does all of this mean? Why is learning about money so important? Do I really need to know all of this? Simply put, yes. It's imperative, even at the most basic level, to properly understand money and the financial system at large so that you can make decisions that will ultimately better your financial situation. This is especially true for entrepreneurs, as money management is crucial to building a business. For example, let's use the basic knowledge of inflation we just covered to illustrate this point. As mentioned previously, inflation is an inescapable certainty that is built into the financial system and designed to occur every year. However, most people don't actually know this or understand it, or at least don't pay enough attention to it. A large portion of the general public save money in a savings account that pays less interest than the average annual inflation rate, and actually lose money over time rather than gain it. By possessing even this simple understanding of inflation, you can avoid making this same mistake and make better decisions for your financial future. Does this mean you have to go out and get an economics degree? Obviously not. But at the very least, you should have some basic knowledge. Just the fact that money education is not mandatorily taught in every elementary school curriculum is beyond me. Or maybe that's intentional. Anyway, that's a topic for another video. Hopefully this video helped you understand how important it is to properly educate yourself about money and inspired you to do so. After all, this is what Martini is all about. Building a community around learning, improving, building success, and leading, financially and otherwise. So make sure and follow us on all the socials, like and subscribe and all that good stuff. It's been Jules from Martini. And remember, keep it shaken, not stirred.